Stop right there. I'm serious. If you're about to buy gold or silver today, January 22nd, 2026, because you saw some headlines screaming about all-time highs and everyone's going crazy, you need to hear what I'm about to tell you because you might be walking straight into a trap, and I don't say that lightly. Right now, gold is sitting comfortably above $4,830 an ounce. Silver has absolutely exploded and is testing the $95 range. Everyone from London to New York is yelling buy. The FOMO is absolutely everywhere. Social media is full of people showing off their stacks. But I'm telling you to stop and wait. And here's why. The easy money trade is already over. The market shifted overnight. And if you're buying now like it's still 2025, you might end up being the person left holding the bag when this thing corrects. And trust me, corrections in precious metals can be brutal and swift. In this video, we're not just staring at some chart and guessing. We're looking at the brand new Goldman Sachs forecast that dropped just 8 hours ago. We're analyzing the Greenland crisis that Donald Trump is actively using to threaten tariffs on Europe, and we're examining the most dangerous number in the entire precious metals market right now, the gold to silver ratio hitting 50, which historically has been a massive warning sign. So, if you want to know whether gold is actually going to $5,400 like Goldman predicts, or if it's about to crash back down to $4,200, you need to pay attention to every single word I'm about to say, because the next few weeks could define your entire year in this market. Let's start with the reality check that nobody wants to hear. Gold hit a brand new all-time high of $4,888 on Tuesday. That's an insane number. It represents a 12% gain in just the first 3 weeks of 2026. But here's what you need to notice. Look closely at what happened immediately after we touched that level. We didn't hold it. We pulled back. And as I'm recording this right now, gold is trading around $4,830. And this is what professional traders call a failure to launch. It's when price makes a new high but can't sustain it, and that's often the first sign that momentum is fading, not accelerating. Now here's where it gets interesting. The retail public, people like you and me who are watching the news and getting scared, we're buying because the headlines are terrifying us. But the smart money, the commercial hedgers, the bullion banks, the institutional players who actually move markets, they're selling. And I was looking at the commitment of traders report this morning, and commercial short positions are at their highest level in 2 years. And here's the brutal truth about markets. When the banks are selling and the public is buying, usually the banks win. They have more information, more resources, and they understand market structure better than retail ever will. But why are they selling right now when gold just hit all-time highs? It comes down to interest rates, and this is critical. We have this massive conflict happening between what the market wants and what the Federal Reserve is actually doing. JP Morgan released a note this week predicting 0 interest rate cuts for the rest of 2026. 0, not 1, not 2, 0. They believe inflation is stuck around 2.5% and the economy is running too hot for the Fed to ease. And if JP Morgan is right, holding gold at $4,800 becomes expensive because remember, gold pays no interest. It just sits there. So if you can get 3.75% in a risk-free government bond, why would you hold gold at an all-time high unless you were absolutely terrified of something catastrophic happening? And that brings us to the real driver behind this rally, fear, specifically the Greenland crisis. Because President Trump's deadline for the European Union is February 1st, he has threatened a 10% tariff on 8 European nations if they block the new security framework for Greenland. And this is why gold spiked so hard on Tuesday. It wasn't inflation data, it wasn't some economic report, it was pure geopolitical panic. People were legitimately worried about escalation. But here's the trap that's being set right now. Reports are already surfacing that a deal is close. Trump mentioned a NATO framework yesterday that caused prices to cool off immediately. And if a deal gets signed before February 1st, that entire war premium baked into the gold price evaporates instantly. We could see gold drop $200 in a single trading session. And do you really want to be the person who bought the absolute top of a war scare that didn't actually happen? Because that's how you lose serious money in this game. Now let's talk about the elephant in the room, silver, because if you thought gold was volatile, silver has gone completely parabolic. Silver is trading at $94.50 an ounce right now. It's up 140% since last year. This is not normal price action. This is a squeeze. This is panic buying. But unlike gold, where the move is mostly about fear and hedging, silver's move is also about real physical supply problems. Because for the 5th year in a row, the world is using more silver than it mines. The deficit is absolutely real. It's not made up. But the catalyst for this specific spike to $95 was the China export ban that kicked in on January 1st. China dominates the solar panel industry globally, and they realized they don't have enough silver to meet their own production targets for 2026, so they effectively locked the doors. They stopped exporting, and now industrial giants like Tesla, Samsung, and BYD are panic buying physical bars just to keep their factories running. They have no choice. They need the metal or production stops. This is why we're seeing the gold to silver ratio collapse so dramatically. And if you don't know what that ratio is, it's how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio sits around 80, meaning 80 ounces of silver equals 1 ounce of gold. But today, it's at 50.1, meaning it only takes 50 ounces of silver to buy 1 ounce of gold. And we haven't seen silver this expensive relative to gold since 2012. And here's the key. When the ratio hits 50, it usually signals a top. It means silver is overbought relative to gold. And if you're an investor trying to build a position, buying silver at $95 is incredibly risky because you're competing with desperate industrial companies who have to buy at any price because their factories depend on it. But you don't have to buy at any price. You have the luxury of patience, and if the industrial panic subsides even slightly, or if China eases those export restrictions, silver has a long way to fall. It could easily retest the $80 level, and that's a 15% loss from current prices. So ask yourself, are you prepared for that kind of drawdown? However, and this is important, there is a bullish case we absolutely cannot ignore: Goldman Sachs. Because while I'm warning you about the short-term pullback risk, the long-term view from Goldman is incredibly strong. Just 8 hours ago, they revised their year-end target for gold. They previously said $4,900. Now they're calling for $5,400 by December 2026, and that's a massive upgrade. So why did they raise their target? They cite central bank diversification. They believe that regardless of what the Federal Reserve does with rates, countries like China, India, Saudi Arabia, and others will continue buying gold aggressively to diversify away from the US dollar. They're estimating central banks will buy an average of 60 tons of gold per month throughout 2026. And if Goldman is right, then buying a dip is absolutely the correct strategy. But buying the top right now is not, because you're paying maximum price with maximum risk. So, what should you actually do with this information? If you have cash sitting on the sidelines waiting to deploy into precious metals, do not chase this green candle. Here's the professional game plan for 2026 that I'm personally following. Step 1. Watch the calendar. The single most important date right now is February 1st. Do not make any major moves until we see the outcome of the US-EU tariff deadline regarding Greenland, because if those tariffs actually hit, gold probably goes to $5,000. You might miss a small gain, but you stayed safe and protected your capital. But if the tariffs get canceled or a deal gets reached, gold will flush down hard to support levels, and that's when you want to be ready to buy. Step 2. Identify your buy zone using technical analysis, because right now we have this massive gap in the gold chart around $4,650, and markets absolutely hate gaps. They almost always fill them eventually. So I personally have buy orders sitting at $4,640 for gold, and for silver, the major support level is at $82. If we get a correction down to those levels, that's where the risk to reward ratio flips heavily in your favor. That's where you're buying value instead of chasing momentum. Step 3, and this is the biggest secret in the market right now. Look at the mining stocks, because while gold is at an all-time high, the actual mining companies, the businesses that dig this stuff out of the ground, are lagging behind. They haven't hit their all-time highs yet. Inflation hurt them badly in 2025. Diesel costs went up, labor costs increased, their margins got squeezed. But with gold at $4,800, those profit margins are now expanding rapidly. Mathematically, the miners are cheaper than the metal itself right now. And if you want leveraged exposure to precious metals without the risk of buying a parabolic commodity at the top, look at ETFs like GDX or GDXJ. Those give you diversified exposure to the mining sector. Let me wrap this up with a very clear warning. 2026 is shaping up to be a year of extreme volatility. We're dealing with prices we've literally never seen before in history. We have geopolitical tensions that change every 24 hours, and we have a Federal Reserve that's losing control of the narrative around inflation and rates. Gold at $4,800 feels amazing if you already own it. If you bought it $3,000 or $30,000,